Why so serious? This chart shows the dollar gold price divided by the yield on the 10-year Treasury bond. Note that the so-called gold bubble of the late 1970s disappears. The entire 30-year-long period since the end of the gold standard turns into one continuous era of tranquility, where investors are compensated for rising inflation risk with higher bond yields, and gold prices and bond yields move in opposite directions, until 2001 when the era of stability ended. 6 years later, the global financial crisis hit in 2007 and the gold versus Treasury bonds yield relationship broke down, with gold reaching above $1,400 and 10-year Treasury bond yields collapsing to 2.5%. One or the other, either gold or bonds, is vastly overpriced today. Here's a chart that tells us which one is overpriced. In 1999, 2 years before Argentina's bond market crashed in 2001, inflation was below zero, even lower than it is in the US today. Argentine peso bonds traded at a premium to global bonds, around 5% compared to 6% worldwide at the time. The entire unsupportable edifice of Argentina's debt-financed prosperity rested on a flawed peso-dollar currency peg. Once currency traders caught wind of it in late 2000, they attacked the Argentine peso and the system went down like dominoes. At first, Argentina's central bank attempted to defend the peso in late 2000 but quickly gave up and announced a dual currency peg in January 2001. Within 3 months, the peso lost 2/3 of its value and more than 70% within 6 months. Argentine peso government bond yield spiked to 40%. But the inflation rate remained below 0% until 2002, as it had since 1999 after years of recession. Not until early 2002 did inflation start to rise, peaking at 40% in late 2002. Bond yields then shot up to 110% when the IMF abandoned Argentina to cope with the global aftermath of the US stock market bubble collapse. Peso bond holders were wiped out. Back to US Treasury bonds and gold. That spike you see in the gold price relative to US bond yields is the float of the fourth currency, gold, against a flawed reserve currency, the US dollar. The low inflation is due to the recession. Secretary Geithner is wrong. The spike in bond yields is the first sign that China, America's IMF, may soon lose its ability to support U.S. borrowing needs due to an impending economic crisis of its own. If the Fed attempts to buy U.S. Treasury bond issuance in place of foreign creditors, Treasury bond price declines will accelerate, and with the dollar demand and the dollar exchange rate, a process not unlike Argentina's crisis may follow. We watch closely as the multi-year drama unfolds.